Welcome back to the Deep Dive. Today, we're really tearing into something huge. How your money is being managed right now.
Or perhaps who is managing it.
Exactly. If you've been following the markets at all, the investment landscape,
Yeah.
well, it's shifted completely.
Yeah, moved from the human trading floor vibe to the server rack reality.
A whole new game. So our mission today is pretty straightforward. We want to cut through all the noise, the buzzwords, and give you a clear map of how artificial intelligence is fundamentally reshaping financial decisions.
Yeah.
The big question, the one our sources keep circling back to, is this. Are human traders actually becoming obsolete? Or is AI just handing them new tools for like a totally new kind of strategic thinking?
That tension is absolutely central, and it matters to everyone listening, really, because the engine driving top financial decisions today is just fundamentally different than it was even, say, 10 years ago.
Right.
We've synthesized a lot of material here to give you the essentials, what you need to navigate this new era. We'll look at the huge advantages, the power of AI, but also the critical challenges it brings.
Okay, let's unpack that shift then, this algorithmic revolution. What does AI investing actually look like day to day? It's not just a fancy spreadsheet, I assume.
Oh, far from it. What's really striking in the sources is the focus on the scale of this change, not just the tech itself. We're moving away from human intuition, human analysis being the absolute primary driver.
Okay.
The real shift is in speed and the power to synthesize vast amounts of information. So AI in finance. It means practical tools, machine learning models finding patterns humans literally can't see or couldn't see fast enough anyway.
So not just automation of old tasks.
No, not simple automation. We're talking algorithmic systems that autonomously optimize portfolios. They detect anomalies. They predict market movements based on really complex nonlinear factors that aren't trackable before.
And the sources point to this really taking off post-2020, a rapid acceleration. Why then? What was the catalyst that pushed AI from a theoretical nice-to-have to the main engine in finance?
Yeah, it looks like a classic tipping point, kind of a perfect storm, really. Three main things came together. First, this absolute explosion of unstructured data, news feeds, social media, regulatory filings, proprietary data, just oceans of it.
Right. Data everywhere.
Second, the cost of computing power just plummeted. Suddenly, running these incredibly complex models became, well, affordable, economically viable.
Okay.
And third, the algorithms themselves, machine learning techniques just got much, much better, more refined. So basically, the engines finally got the fuel, the data, and the horsepower, the cheap processing they needed to scale up massively.
So that explains the why now. We've defined the revolution, but let's get into why everyone, even the old school skeptics, seems to be using it now. What's the undeniable advantage?
The edge.
This brings us to part two. Speed, scale, prediction. Let's start with the sheer volume. Data. Our sources really hammer this point. AI's power to just inhale information.
Yeah.
We're talking terabytes of data sifted through daily. Earnings reports, global news, analyst notes, regulatory shifts. AI finds the actionable bits.
Things a human team couldn't possibly ingest, let alone analyze on that scale.
It's just not physically possible for humans.
Exactly. And that's where the speed metric gets, frankly, a bit mind-bending. Data ingestion is just step one. Some of our sources noted that top-tier algorithmic systems can now make and execute, get this, over 40,000 decisions per second.
40,000 per second.
Per second. That's a speed increase of maybe, 90% compared to even advanced human-managed high-frequency desks just 5 years back. It changes the market's DNA.
Wow. 40,000. That's like comparing, I don't know, dialing a rotary phone to a 5G data burst.
Yeah.
The scale change is immense.
It is.
How do regulators even keep up with that?
That's a huge question, and one we'll touch on. But let's stick with the capabilities for a moment. That speed enables incredible predictive power.
Okay.
We're way beyond simple trend lines now. We're talking sophisticated prediction using tools like sentiment analysis.
Sentiment analysis. So figuring out if the market mood is good or bad.
It's more nuanced than that. It's not just keyword scanning and headlines. It's AI parsing the tone of executive earnings calls, analyzing the chatter on social media for those early, faint whispers of market shifts, reading between the lines in dense regulatory documents to gauge the real underlying mood, quantifying human anxiety or excitement much faster than any analyst could.
Okay, I see. So you combine that predictive insight with the execution speed.
And you fundamentally redefine how you manage risk and spot opportunities. You can manage these enormous complex portfolios and rebalance them almost instantly in response to global events.
And this is why the sources kept emphasizing financial literacy, right? For you, the listener. If markets react in milliseconds, driven by these forces, you have to understand the basics of what's going on behind the curtain.
Absolutely. If you don't grasp this dynamic, you're constantly playing catch-up. You're reacting to events that the machines priced in ages ago, relatively speaking.
It's a crucial point.
It is. And it's a good transition, actually, into the risks, because this kind of exponential power, it demands serious oversight, which leads to this core idea that collaboration, human-AI collaboration, is really the path forward, not replacement, because the risks are significant.
Okay, let's get into that, the double-edged sword. Our sources highlighted 3 major risks in this high-speed, data-soaked world. First up, what happens when the AI learns the wrong things? Algorithmic bias.
Algorithmic bias, yeah, this is critical. It happens when the AI, trained on historical data, internalizes flawed patterns from the past. If that data reflects old human biases, like maybe favoring certain types of companies or certain regions, or if it includes weird market events like the 2008 crash as normal,
Then the AI just repeats those mistakes.
it can perpetuate them, yes, but the real issue is synthesis and scale. It can amplify them.
Wait, amplify. How does it turn old data into a new problem, beyond just repeating the past?
Okay, think of it like this. A small, perhaps even subtle, historical bias in the data might get identified by the AI as a strong signal. When the AI applies that signal across a massive portfolio managing billions, that small bias gets scaled up hugely. It distorts capital allocation systematically.
You need to give an example?
Sure. Say a model learns from decades of data that only companies in established Western markets showed consistent, stable growth. It might then systematically underinvest in promising emerging markets today, even if current metrics look fantastic. Why? Because the historical data baked in a bias against the volatility often seen in those markets historically.
Oh, I see. So the bias becomes embedded, codified, and executed at machine speed.
Exactly. And that leads us to the second major risk, market volatility.
Right. When things go wrong at that speed, the consequences can be immediate. We're talking flash crashes.
Precisely. A flash crash is like a sudden, violent market seizure because all these systems are so interconnected, reacting to each other in microseconds. A single bad trade, a data glitch, or an unexpected feedback loop between algorithms.
It's cascades.
It cascades through the system faster than any human can possibly react, let alone understand what's happening. The market essentially breaks itself for a moment because of its own speed.
Scary stuff.
And the third big risk area our sources flagged is cybersecurity.
Makes sense. If these algorithms are the secret sauce.
They're arguably the most valuable intellectual property these firms possess. Protecting the algorithms, the models themselves, and the vast data sets they train on, it's paramount.
And concentrating all that power and data creates a massive target.
An extremely high-value target for cybercriminals, state actors, you name it. A breach could be catastrophic, not just for the firm, but potentially for market stability.
Okay, so bias, volatility, security. These are serious downsides.
Which is exactly why, as the sources argue, the future isn't about firing all the humans. It's about collaboration. You need humans in the loop to mitigate these specific, critical risks.
That brings us neatly to our final section. How do we navigate this AI-powered market? If AI is incredibly powerful but also inherently flawed, the strategy seems clear. It's about oversight.
Right. The new frontier, especially in active management, requires human judgment. It's the human analysts who question the model's outputs, manage the bias, set the circuit breakers for volatility, and ultimately ensure the AI is learning the right lessons from the data.
So for you listening, the takeaway isn't just AI is important, it's about where the smart money is going. Our sources strongly suggest focusing on identifying AI-driven opportunities, investing in the tool, not just passively benefiting from it.
Exactly right. When you evaluate a company now, you need to ask, are they just using AI for, basic cost-cutting automation? Or are they strategically leveraging AI, using it to gain real market share, to innovate, to manage incredibly complex global supply chains, maybe disrupt entire business models? The sources suggest focusing on those companies where AI informs core management strategy. Those are the potential value creators in this new landscape.
Looking further ahead, the sources point to 2 really fascinating developments on the horizon. First, this critical need for a shared, transparent, ethical framework.
Yes, and this isn't just about, doing the right thing. It's a practical necessity, a regulatory safeguard. We need globally agreed upon standards for how these models are audited, how they're stress tested, to ensure fairness, yes, but also to manage the systemic risk.
Systemic risk from what? Shared biases.
Shared biases, potential cascading failures if everyone's AI reacts the same way to a shock. We need rules of the road to prevent correlated meltdowns.
Okay. And the second big trajectory, this sounds almost sci-fi, hyper-personalized portfolios.
This is really exciting, I think. We're moving beyond just simple risk tolerance questionnaires. We're talking about tailoring investment strategies down to the specifics of your individual life, your unique tax situation, your long-term goals.
And crucially, your personal ethics.
And your personal ethics, exactly. This is key. Imagine a portfolio constantly optimized, not just for maximum return, but to align perfectly with your values.
So avoiding specific industries I don't like, or maybe actively prioritizing investments in, say, local businesses or green energy.
Precisely. AI can handle the immense complexity needed to enforce those kinds of granular, personalized rules across a portfolio, 247, something that was just impossible for a human advisor juggling hundreds of clients to do effectively before.
The sources also mentioned AI opening up areas like alternative investments, emerging markets, places that were traditionally harder to analyze quickly.
Yeah, AI's ability to process unstructured data and find patterns can cut through the opacity in those markets. It could open up new avenues for genuine diversification beyond just standard stocks and bonds.
Great, let's try and wrap this up. We boil down this deep dive.
I'd say the core finding is this. AI is undeniably the engine of modern finance now. Speed, data processing, it's unmatched. However, that power creates serious systemic risks bias, volatility that absolutely require human oversight. Human-AI collaboration is the model.
Yeah.
And the key takeaway for you, the investor, in this complex, high-speed world, your own financial literacy, your understanding of these forces is more valuable than ever. Plus, keeping a critical eye on how companies are actually using this tech.
Okay, so we've talked about this trend towards hyper-personalization. AI tailoring strategies right down to an individual's ethics, their specific beliefs. An unprecedented alignment of personal values and financial strategy is becoming possible. So here's a final thought to leave you with, something to mull over as this all unfolds. Given AI's growing power to cater to every single nuance of your financial identity and your ethics, does a simple, standardized passive investment approach still make sense for the long haul? Or will our individual financial ethics, our personal values, soon become the main force shaping market strategies? Something to think about.